Holdings are simply the underlying individual assets that make up your investment portfolio. They can include a number of different investments, but they usually comprise mostly of equities and bonds, although other asset classes may be included as well. To keep things simple, in this video we will focus on equities. If you decide to directly purchase some of the shares of a business, you have a direct holding. The size of the holding is measured by the number of shares that you own, and its value is the number of those shares multiplied by the current share price. It is called a direct holding as there is no intermediary between you and the market, so you are registered as a shareholder and able to attend the company's annual general meeting and vote, although you may hold your shares via a nominee account to simplify administration. Another way of investing would be to purchase a share of a pooled fund. This is an indirect holding as there is an intermediary in the form of a fund management company between you and the underlying shares. So, you would pay the fund, which would then invest into a number of holdings on your behalf, and then any dividend payments would be returned to the fund, which would then pay out to investors. Pooled funds, which are sometimes called mutual funds, contain the capital of many investors, each of whom owns a proportion of all the assets in the fund according to the value of their investment. If the fund owns shares in 4 companies, each comprising 25% of the portfolio, each investor has 25% of their holdings in each underlying company. I've chosen the number 4 in this video to keep things easy to visualize. However, in reality, it is likely that a fund would have many more holdings. When investors pool their capital, they may be able to take advantage of the fact that the fund manager is probably placing larger trades than the individual investor would and can therefore deal at a lower cost. Certain trading opportunities are only available to larger investors. The ability to spread their investment, even a modest one, over more holdings than could be achieved economically if investing on their own. A tax advantage if the fund in which they invest is exempt from tax on transactions within the fund. Improved diversification, reducing the impact on the portfolio of the poor performance of a single company, sector or region. Reduced administration compared to owning a large number of individual holdings and having to research, monitor and trade them. The downside is that control of the holding is handed over to a management team, which can then add additional costs compared to owning a direct holding. Additionally, the benefit received from any capital gains from individual holdings within the pooled fund will be diluted by those holdings whose price has not risen, therefore reducing the overall return compared to only owning the holdings which rise in value. Although this is no different to owning the same portfolio directly. Conversely, this can also reduce the impact of losses. If you'd like to find out a bit more about investing, please do reach out and get in touch with us. Or, conversely, read the Bloomsbury Guide to Investing.